Hey everyone, how is everyone doing? I am now live streaming right now, and I'm taking a look at the S&P 500 as we are now on week 7 of one of the most extraordinary bullish runs ever in market history. It's definitely one of the most craziest rallies that I've ever seen in my entire life. Uh, Absolutely nuts. So I've been doing this now for 21 years, and this rally is just out of control. I mean, this is just nuts. And we take a look here, looking at the S&P 500 chart over the past year, um, and I mean, I've talked about this before. Basically, I came into the year looking for kind of a sideways chop type of market. My model for the S&P 500 going into the year was basically something like what we experienced during this period of time. And I go back here to the late 2014 to 20 to 2016 to 2017 period. Late 2014 to late 2016 period. We zoom into this period here. This is September 2014. This is January 2015, 2016, all the way to December 2016. I came into this year with the basic model or idea of that we were going to have a sideways chop type of market uh, that would look that would end up looking similar somehow, some way, to what we went through during this period of time. Basically, up, down, up, sideways, down, up, down, up, down, and then eventually we broke out to the upside, and continued to rally. But during this period of time, we were basically, for all intents and purposes, in a sideways chop range. And what we were going through uh, in late 2014 and early 2015, right here, basically up a little bit to sideways, was kind of, in a sense, what the market was looking like uh, towards the end of last year. We had this down move and then came up, another down move came up, and kind of was going sideways. It was kind of, in a way, similar to what to the end of 2025 and the beginning of 2026 was kind of similar to what the market was looking like towards the end of 2014 and beginning of 2015. And as the year so far has played out, we were going sideways. We're in a sideways range. I was going on, and at the time it was going nuts because it was like, oh, the market's not really doing anything. It's just going back and forth, back and forth. We can't have a solid breakout to the upside, but we can't have a big down move lower. We're just chop back and forth. And then the news kind of escalated, became more volatile with the Iran war, as that narrative increased that we were, attacking Iran, and oil prices were going higher, and the market started selling off from that, and the higher oil prices kind of became a ceiling for stocks, and the sideways action kind of picked up into or became a more bearish sell-off. But it was never really a vicious bearish sell-off, in my opinion. I never thought that this was a huge sell-off in the market during March. It was a bad time if you were a bull, and it was, bearish to the downside. But from where we were at the end of January, just above 7,000, to where we were at the end of March, below 6,400. That's about a 10% sell-off from peak to trough. And there was an interview at CNBC with Warren Buffett, and Becky Quick was interviewing Warren Buffett, and she's like, you have all this cash, are you gonna invest? And he said something like, it's only like 9 or 10% correction. We haven't really sold off that much. And I never really felt the fear to a large extent during March. And at that point, I was looking for a rally to come. At this point, I was very, very, at the end of March, when we were at 6450 to 6400, I was looking for a rally, and I was right about that. And I thought we got a rally, but like at this point here, when we bounced off the low and got the reflexive rally, at this point, when we got to about 6,800 to 6,850-ish, I was like, okay, we got a rally. But nothing's really changed. Oil prices are still up. It's looking more and more, in hindsight, it's looking more and more like inflation could become an issue. Markets in this sideways chop range. And at this point, right around, once we got above 6,800, right around 6,850, 6,860, I was thinking that we were going to, at some point soon, maybe get to 6,900, maybe get close to 7,000, but then roll back over, just like we did back in 2015. So up to that point, my analog was spot on. I was really looking like a genius. And we'll go back and take a look at that analog. This is why analogs, 99 times out of 100, they don't work out, because the market's always doing something new and interesting. But us as humans like to have some type of model to think about what we do, so that we can project the future, so that we can come close to being right. Go back to this 20-year weekly chart. So this is a weekly chart. I was looking at a daily chart. This is a weekly chart. We go back to that period. So at this point, it looked like we're going up or sideways. We sold off. And my thinking in my head was, okay, we're going to get a rally and then we're going to sell back off. Well, this analog was looking really good to a certain extent, but it is no longer the case, as we have blown out to all-time highs and further chops sideways, like what we had in late 2020 or 2015 and 2016. This is no longer looking like it's the case. So this analog is no more. It doesn't work any. It doesn't fit here anymore. It doesn't work out here anymore. It's no longer the case. As we go back to the current market, and we have just had a huge rally to the upside. We kept going higher and higher and higher. And what happened was earnings season started, and companies started to report earnings, and as earnings season went on, day after day after day, more and more companies reported earnings, and they all beat their numbers, raised guidance, and more importantly, company after company after company talked about AI and talked about how it's no longer just the hyperscalers that are making money from AI. Now you have other companies that are suppliers for the hyperscalers that are involved, that are smaller companies that are involved now using AI, are actually making money and having return on equity from the investments that they've made in AI. And hearing all of that, plus in addition to hearing the structural issues that we have in the economy. So now you have smaller companies, both smaller public companies and then smaller private companies actually using AI software. So you have the private companies actually using AI software to boost productivity. Then you have the smaller companies that are public companies. They're smaller companies that they are smaller than the hyperscalers, but they're larger. They're large companies that are suppliers to AI that are now using AI and also they're using AI for their own productivity, but also making products to sell to the hyperscalers. So the whole AI phenomenon is really trickling down to the economy on all aspects. And throughout this earnings season, CEO after CEO after CEO has been describing how AI is increasing their productivity. They're getting a return on their investment from AI. So they invested in AI infrastructure, but now they're actually getting a return on their investment from AI. And on top of that, we have this interesting dynamic that is confirmed from earnings call after earnings call after earnings call that we don't have enough compute, we don't have enough CPUs, we don't have enough GPUs, we don't have enough fiber optics, we don't have enough things like SEPRA transistor thinnies. These are things that they connect, that Astera Labs makes. It's called SEPRA, and it connects the cables from the cable into the server and the GPU and the CPU and so on and so forth. We don't have enough high bandwidth memory. We don't have enough, storage. That was one thing I thought. I was like, okay, we don't have enough high bandwidth memory. But after this earnings season, I'm finding out, okay, it's not just high bandwidth memory, it's also CPUs, GPUs, fiber. We don't have enough silver. We don't have enough copper. We don't have enough fiber optics. We don't have enough. We're compute constraint across the board. And the market has realized that. And this rally is basically, in my opinion, I've talked about how it's gone up because of the gamma squeeze. How the velocity of the move higher is from dynamics of the marketplace, like zero DTE options that are attributed to pushing to the velocity to the upside, pushing the market higher. And that is a big thing. That is a major dynamic, I think. But also, from a fundamental point of view, the market is pricing in the fact that you're getting huge earnings growth in the underlying companies of the S&P 500, and that earnings growth is being priced into the market. So you have a structural reason that has pushed the market higher for 7 straight weeks, in the fact that you have the options market with 0 DTE options are attributed to the viciousness of the rally to the upside. They're pushing, the options themselves are pushing the rally up faster and higher, faster than I've ever seen before. And others have said the same thing. Nobody's really seen a rally this vicious, this fast like this. That is because of structural evolutions in the market, like 0 DTE options, creating these gamma squeezes to the upside. But you also have a fundamental reason in the fact that artificial intelligence is trickling down through the economy, through these companies' earnings, and the market is pricing in earnings growth that is going to be in the 23-24% range now. I learned just before I came on, I was listening to a guy who is an ex-market maker. I don't want to mention any names, but I may slip his name in the future. And he's an ex-market maker. He's pretty popular on X and YouTube and all that stuff. But he was basically saying that he's making the argument that we're in a bubble, and he's been arguing that we're in a bubble. And he said, in 1999, the earnings growth of the S&P 500 was 27%. Right now, it's 23% or 24%. And he's 100% right. I double checked what he said. He's 100% right. We're very, very similar in that regard. Even in '99, we're still not at 27% earnings growth in 2026. We're only at 23%, but that's very close to what it was at in 1999. The issue I have with that argument, and I think he's got a very interesting comparison. You're comparing 1999. That's a good argument. Compare the earnings growth of 1999 to the earnings growth that we have now in 2026. But what happened with the dot-com bubble was that you had, in the late 90s, not just 1999, but in the couple years before the 1999, you had a huge boost in earnings growth. You had lots of CapEx, capital expenditures, like we're having now. You had this huge boost in growth in the economy as they were building out the internet. The issue is as we got into the new century, the new millennium, we had what is known as, the term is called dark fiber. You had all this dark fiber, which is basically means that they built out the internet. They had all this huge CapEx, building out all these servers and fiber optics and so forth. But there was too much infrastructure in fiber optics and servers and so forth that did not need to be used. The internet was being adopted. People were using the internet. They started getting AOL and so on and so forth. But the use cases at the early stage of the internet were basically email, downloaded music, porn, and stock quotes. What else were we using the internet for? Chat rooms? Okay, chat rooms, 5. So you really have like 5 main use cases. Chat rooms, reading, maybe 6 use cases because you're going on news sites too. So you're going on news sites, you may be doing a little bit of online shopping. So that's a use case. Going on news sites, reading different stuff online, but for the most part, people at that point, like in 1999, 2000, actually liked reading magazines still and newspapers. But you could go online and read stuff online. You were using it for chat rooms. You were downloading porn. You were trying to buy stocks, and you're downloading music if you could. The idea of downloading a whole movie at that point was not even imaginable. And for the most part, there was too much, not for the most part, there was too much fiber and too many servers that were built, too many cables that were built, and it wasn't being used. And companies realized, oh, we don't really need to build out the internet. It's built out to a large extent right now. So we're going to reduce our capex, and we're going to rein in the reins, and we're going to lay off some people and kind of back off and let the public continue to use the internet. And we're going to allow user adoption of the internet to increase, and people will find their new use cases to use the internet. So that eventually happened, but it was a slow process. Okay, Google came around in 2004 was when it really became popular. 2005. Netflix really was just mailing out video, the DVDs in that started in 2003, 2004 period. So forget about streaming movies and all this stuff that we do now. All the use cases came about as time went on. The iPhone didn't exist, so any mobile internet, any idea of doing anything on the internet through mobile was not even a funk in anyone's mind at that point in 2000. So there weren't use cases. There weren't people saying, oh, I want to do all this stuff. I'm waiting for the internet to be built to do it. No, we were finding our way. And then the dot-com bubble hit, the stock market crashed. And let's, as I'm speaking, let's zoom out and take a look at the, let's go back in time. Let's take a look at the 20-year, no, we're going to have to go back further than that. A weekly chart over back to the day. So this is like 1999. So basically this is the dot-com bubble, and this is what everybody keeps comparing us to. So this is like 96, 97, all the way to the bottom of the dot-com bubble. So you had this huge run-up, 96, 97. You had a big run-up in 98, but you also had a big sell-off. There was something that happened here called the Asia Contagion and the long-term capital management crash. Big hedge fund blew up called long-term capital. And then we came back up, we rallied, and we rallied up through 1999, and then we had a huge blow off top and then sold off. Now, when you're looking at the NASDAQ, it was even more vicious. You can see that rally. It was a huge rally up in 1999 and 2000, and then the bubble popped, and we just went down for throughout 2000, 2001, and even through 2002, where we eventually bottomed in late 2002. And that's what everybody's comparing what we're going through now to. The thing about AI that I think is different, and I'm being cautious saying this because you never want to say it's different this time, you know, this is a huge run. I'm very humble in the fact that I do know that this market has had a huge move. It is way extended and way overdue for a pullback sell-off. I am very aware of that. Okay, I'm not saying that the market can just keep ripping higher forever. I don't think that's a good thing. I'm actually kind of glad, as a bull, I'm glad that the market is down today. I mean, after this huge move that we've had. This is looking at the Nasdaq over the past year, and you can see the move is even more prevalent. But after this huge move that we've had, I'm kind of glad that we've had a down day, and I think we should have more than just one down day in a row. Maybe we can get back-to-back down days in this market. But we need a break. We need to consolidate. We need a sell-off. We need to go back, revert to the mean, and kind of blow off some steam. But long term, big picture, I am not bearish in any way, shape, or form. Short term, yes, we're extended. Short term, we need to sell. Short term, we need to correct. Short term, we're way overbought. And that's all true. But, and I'm going to go through some stocks in a little bit, and you'll see many charts are super extended. But long term, one of the main structural things that is interesting about AI that is different than the dot-com bubble, in my opinion, is that at the end of 1999, the beginning of 2000, there was tons of dark fiber. The big difference is that there are no dark GPUs. There are no dark servers. There are no dark cables or fiber. There are no dark anything. There's not enough. And there's lots of use cases now. There's companies, individual people, small companies, public companies that are saying, oh, okay, there's things that I want to do with AI. There's ideas that I have, dreams in my mind of what I want to do as a CEO, as a small business owner, and so forth. But I technically can't because it's too expensive. It's too expensive to build this or do that or whatever. If I use AI right now, I can't get. It would cost too much money to spend money, to continuously spend money to buy tokens to build out whatever I want to do with AI, especially if you're a small business owner. But, and I'm speaking for myself, we have ideas of what we would like to do. If I could have access to more tokens, which means more access to more GPUs, more CPUs, more high bandwidth memory, more servers, more, then I would love to do it. And I know other business owners and other CEOs have they're in the same place. They want to use AI more and more. It's just that they can't because we're compute constrained. So this dynamic that, oh, we've built out all this stuff, we spent all this money, we have all this growth, it's going to stop next year or the year after that. We're not at that point yet. Now, could that happen in the future? Absolutely. No doubt about it. The possibility of that happening is definitely possible. Someone on the All In podcast brought this up. Okay, I'm gonna pull this up. I want to show this. It's a great podcast. Okay. Let me look this up. This guy was recently on Joe Rogan, and I cannot ever pronounce his name properly. Shamal Papatia, I think, is the best. The best way I could pronounce it. But he mentioned it on a recent episode of the All In podcast. He gave a very interesting bearish case for the stock market in AI. And it was actually something that was like, okay, I get it. That makes sense. And he's a bull. He's a long-term investor, and he is a venture capitalist. He was one of the original investors in Facebook. And this is the podcast, the All In podcast. It's fantastic. It's got over 1 million subscribers, and it's on weekly. In this episode right here that came out 6 days ago, Shamal, that's this guy right here, Shamath Papatia, or something like that. I apologize for mispronouncing his name. But he, on this podcast right here, that came out 6 days ago, he talks about how at a certain point, these companies are going to need a return on capital from the tokenization, the use of tokens, the tokenization use. And at a certain point in time, whether it's a year, year and a half, 2 years, 2.5 years, at some point, it may be, he actually says, maybe 500 days from now, 600 days from now, something like that. So a year, year and a half or so forth, they're going to start to look at the amount of return on capital that they're getting from tokens. And if they're not getting enough capital, if they're not getting enough return on capital from tokenization use, they're going to drop their CapEx. And you're going to have multiples on stocks come in, and that's going to create a sell-off in the market. And that is definitely possible. However, you want to be optimistic. The way that people and companies are, finding use cases for AI, and now companies are getting return on equity, return on investment with AI, and there's demand for AI that in all the earnings calls, they're all saying the same thing. The demand is surging. The demand is sensational. The demand keeps rising. This is going to continue for at least the next year to 2 years, kind of thing. So at this point, the progress in AI is continuing. People are finding use cases. People are getting return on investment. They're making money from applications they're using with AI, and they're going to keep spending on that. But as they keep doing that, as they keep spending on AI, if they're not getting enough, and what Shamath is saying is they're not getting enough return on investment to offset the amount of money they're spending on tokens, they're going to rein in the horns. And that will mean that they're going to reduce capital expenditures, and that will mean that stock multiples have to compress, and that means that we're going to have a stock market sell-off. And Shamath said that could happen, sometime in the future, a year and a half from now, 2 years from now, something like that. So, but for the foreseeable future, for the next, whatever, he said that the market could keep rallying, and I agree with that. And any sell-off needs to be bought. I have been searching and looking for a bearish a bearish case to offset my bullish optimistic outlook, because I want to hear the opposite end of the coin. I'm a bull, I'm an optimist, and there's just so much junk out there, right? Like, give me something tangible, something that makes sense. And most of the perma bears out there are just the stuff. Just, I don't know, just makes my head want to explode, because none of it makes sense. Oh, the market's up. It's a bubble. Well, tell me why. It's interesting to me that a venture capitalist and famous investor who's an optimist and a bull actually lays out a concrete, reasonable, realistic bearish case. And the thing is the other guy on the All In podcast, David Sachs, and Brad Gerstner was also on the podcast. He's a famous investor as well. He's on CNBC a lot too. He goes, but if these companies are gonna continue to innovate in the way that they are innovating and keep using AI in the way that they have been using it, they're going to find, my outlook is they're going to find use cases for the tokens, that they're going to figure out ways to monetize the tokens and make more money using AI. So we'll see, and hopefully that's the case. And I hope and think it can happen, but it's always good to watch your back and know that at a certain point in the future, if these companies are not making enough money from using from the tokens that they use to create things with artificial intelligence, they're going to back off in CapEx, and then stocks are going to sell off as multiples compress. So with all that said, let's go through some various stocks. There is one thing that I wanted to talk about before we go to individual stocks, and that is a topic that I discussed last week on interest rates. So I do want to discuss interest rates before we go to individual stocks. And we scroll down here and we take a look at the 10-year. This is the 10-year interest rate. It's quoted, I hate the way they do this, but it's quoted at 45.95, and that is equal to 4.595%. So basically, interest rates are now continuing to climb, and on, I think it was Tuesday or Wednesday, but earlier this week, the producer price index came out, and the producer price index is the choice economic inflation data that the Fed looks at, and it was very, very hot, and the market shrugged it off. But today we're getting not just a rise in interest rates, but we're getting a sharp rise in interest rates. So it's one thing if interest rates go up on higher inflation expectations or whatever it is, the market can handle that. What the market gets jostled with is when you have a up move in interest rates that's a sharp up move, it's fast. So it's not just the direction of interest rates, it's the velocity of interest rates. And today you have interest rates going up, taking out the 4.5 level, but they gapped up and are continuing to go higher. And that move up in interest rates, and you can see it across the curve. We're just looking at the 10-year here, but all interest rates across the curve, the 2-year, the 5-year, the 20-year, the 30-year, they're all higher today. And the velocity is higher. across the board, and that is dragging stocks down. I think that is the specific catalyst, if you want to point out a catalyst to cause the sell-off today. And it's still not that big of a sell-off. We're only down, 1.2%. It's not crazy. The S&P is only down 1%. I mean, come on. After the big move that we've had, you can make an argument that this could be just coincidence. The market's just down today because it's overdue to have a down day. So, take everything with face value, okay? But interest rates are down. Sorry, interest rates are up. Stocks are down, and the bond market is selling off. Take a look. So as interest rates go up, bonds go down, and we can see a big down move in the bond market today as interest rates pop. So that is a dynamic that is dragging stocks down today, probably. If you had to give a reason why the market's moving the way it is, that's why. Now, we were moving down in the bond market, but the velocity down is now very, very fast, and that's dragging down stocks today, probably. So, all that said, what is interesting is that when we look at the interest rates for the future, we go to the Fed Watch tool here, and we take a look at interest rates for the future. Right now, the current Fed funds rate is at 3.5 to 3.75%. So that is where the rate is for the Fed funds right now. And we look at the upcoming meeting on June 17th, and that's the first meeting with Kevin Warsh as Fed chair. There's a 99.2% chance that the interest rate, the Fed funds rate, is unchanged. Now, we go out into the future and we look at March 2027. And what's interesting is you see how there's a very fascinating curve, because the current rate is 3.5%, and all the probabilities are for interest rates at higher levels. And there's only a 0.02% chance that the Fed funds rate will be below where it is now. So that's where it is. You see that in the chart. Basically, there is a 72% chance that the Fed funds rate will be higher by March 2027. So the market is looking for the Federal Reserve to hike interest rates now, not cut interest rates. So for so long we've had the this narrative that Kevin Warsh is coming to the Fed. We're going to kick out Jay Powell. Jay Powell, he's going to leave. Kevin Warsh is going to take over and cut rates. And you've had Donald Trump saying, Powell needs to cut rates. Too late, Powell kind of stuff. And now you have Kevin Warsh take over, and that Trump wants him to cut rates, but the market is saying that's likely not to happen. Now, this can all change, but the way interest rates are going up and the way that high oil prices are trickling down through the system and causing other price pressures or prices to rise other than just gas prices. The PPI report confirmed that prices are rising because that prices are rising and inflation pressures are now in the system since oil has uh, gone higher and continues to sit at around $100 a barrel. And I'm going to remove this and take a look at crude oil here. And now crude oil, it was very low, constantly below $65 a barrel, and now we are constantly around $100 a barrel, and it has now been 1 month, 2 months, 3 months, going on 4 months, at these higher price levels. And the PPI report confirmed that these higher oil prices are causing inflation throughout the system, and that has caused Treasury notes to fall and interest rates to rise. And that has caused the market to say the Fed needs to hike interest rates. So that's what's going on in macro land. And I think it's interesting because I wonder if enough time goes by where interest rates stay high and Kevin Warsh actually hikes interest rates, what's Trump going to do? Is he going to say something to him? Is he going to be yelling at him? And then what are the repercussions of that going to be? So, I don't know. I can't predict that. But that is the situation that we're in now, is that inflation is trickling through the system, and the market is saying that the Fed needs to actually hike interest rates now. And another thing is that the Fed hiking interest rates specifically because inflation, that could be a very bearish thing for the markets. So regardless of what AI does, you can get a sell-off in the markets because of inflation, and that's exactly what we got in 2022. Inflation got out of control. The Fed started hiking interest rates, and bam, stock market sold off for multiple months. So that could happen too. So that could be a bearish case for the market. So yes, you have tokenization, return on investment issue that Shamal brought up. That could hurt stocks, but also inflation going higher and the Fed raising rates. That could be a bearish state for markets. So those are the best two bearish arguments that I have right now. And let's go to what I have been wanting to do more of in my live broadcast, but I just get on a tangent and just talk. I think that if you don't understand, fundamentals and macro landscape, and kind of have a fundamental mosaic of a fundamental foundation for how you go about just picking an individual stock, you're missing the big picture. I think understanding what's going on, underneath the surface is very important. And because, you need the market, you need to have the wind behind your back, and you have to know, even if you're bullish, and even if you like to, even if you're optimist and you're a bull like I am, you still have to, be on the lookout for storms on the horizon. And you can't be a Pollyanna. You can't be naive, because the markets are going to have periods of sell-off. And if we are in a bubble, at a certain point we got to get out. You got to you know, you gotta recognize it and trade accordingly. You know, sell stuff, get out. Um, but that is the foundation right now, and I think that the Fed hiking rates could be very bearish for stocks for a certain period of time. So that is the bearish case, in my opinion. You know, so. But for right now, everything's very, very bullish, and we're just short-term extended, and we desperately need a pullback in the markets to consolidate the big gains. Now let's look at a couple individual stocks here. We've been looking at NVIDIA. It's the main stock. It's had a clean breakout to the upside, and it's had a clean breakout to the upside, and it's having its first down day in a while, and everything looks very, very bullish here. It just needs to have a retracement. It needed a break today, which is what we got, and you can see here we're pulling back to the upper Kepler channel in NVIDIA, but we made new highs in the stock, and we made new highs in momentum, so that is very bullish in my case, and we may have more days than just one down day going forward, but those down days can be bought, and I think here is the 20-day moving average for NVIDIA. I think that's a good spot to buy NVIDIA if it retraces close to where it was before it broke out. So it may, you know, it could go to 220 or 215, you know, back to where the previous resistance was, and at that point, you know, the 20-day may inch up a little bit, and at that point, that would be a good spot to add. But everything looks very bullish here for the most part. The one thing that sticks out to me on the daily chart is that the slow line here is not above the previous high for the slow line on NVIDIA. So that is confirmation that momentum in the long term is slowing down. This needs to get above as time goes on. It's good that it's up sloping and it's good that it's rising, but it needs to get above this slow line on the next up thrust in the stock. Since the fast line and the rate of change made highs, it's most likely the case that any pullback gets bought in NVIDIA. But on another upswing higher, if this slow line does not get above this previous high here that we made here in April, look for the slow line to start to flatten out, and that will set up for another more aggressive sell-off in NVIDIA going forward. So that's how I see NVIDIA right now. Right now it's a clean breakout. Everything looks good. Any pullback is a dip, but as time goes on, that may no longer be the case. Let's take a look at Micron. Micron has had a fantastic move up and is now finally pulling back a little bit. And take a look at this chart here. We're still in a very extended run to the upside. We're still above the upper Keltner channel. We're still way above the 20-day, and this is a normal natural pullback. And at this point, at 727 a share, it's most likely that we will go back to this upper Keltner channel and trade below 700 and quite possibly get closer to 600. This is the 20-day moving average at 605. So don't count that out of the woods. It makes a lot of sense for the stock to easily go below 700, but it could go towards 650 or maybe closer to 600, and that can set up for a buy entry. The fact that we made these highs and made momentum highs in the oscillators, that is indicative to me that this natural pullback that we're seeing now will get bought. However, we're just now going below zero on the rate of change, and we're just now seeing the fast line go below the slow line. We can easily go negative, okay, on the fast line, and we can easily get closer to this 20-day. So Micron can go a lot lower than where it is now. It needs to pull back. This is all normal and natural, and what the catalyst is for it, we don't know. I mean, maybe it's all that interest rate stuff I said earlier in the broadcast, but none of this is bearish for the long term. Okay, any move below 700, closer to 650, and maybe even closer to 600 is a buy in Micron. But everything looks really, really good here. The slow line is trending higher and it's at highs, so that means that the stock can keep going up. Everything looks great, and it's just super extended. It needs to take a break. That's all. So if you're looking for a short-term trade to buy calls, I would back off right now. Back off and wait for the stock to show more constructive action, that it found a bottom, before you jump in to buy calls. If you're looking to buy stock, the levels that I would look at are at 650 and then closer to this 20-day right above 600. And I would, scale in. So if you wanted to buy, say, 100 shares of stock, put it in order to buy 25 shares at 700, put it in order to buy 25 shares at 650, and put it in order to buy 50 shares at like 605 or something like that, and adjust it and incrementally buy as it goes down more and more and more. And then you wake up one day and it pops up and it goes up and you're like, oh, okay, good. And you have at least a meaningful position. Now, do you always buy all the shares that you want? No. But then when the stock starts going up, 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 you buy it as it's rising. And you play this out. You buy 25 shares here at 695. You buy 25 shares here at 650. You get the 100. You get like 25 shares here at 605. And then it bounces a little bit, goes up. It goes to 670. You buy the remaining 25 shares, and then it bounces around. It gets to 763 as we get towards the SpaceX IPO, and then it starts getting talked about on all the media outlets, both internet and on television, and you're in before it makes another big move higher. So Micron looks very interesting. Let's take a look at another stock here. Let's take a look at see here. Bloom Energy, it's having a nice natural pullback here. First down day in a while. And we're about to have the closing bell. So I'm taking a look at my positions here. And I got slaughtered today. I lost a lot of money today. I had a huge down day today. Absolutely massive. Taken to the woodshed. It was just brutal. Just brutal. Just looking at my positions, looking at all the money I lost today. Huge losses. Gave back a big portion of my gains over the past week. This is what happens. You have to be able to hold through the volatility. Whew. So let's take a look at Bloom Energy here. And we look at this chart here. It is now pulled back below the upper Keltner channel. And see that we have a divergence here in the fast line. We made new highs and then did not make new highs in a rate of change. We had a turn down in the slow line, and we had a divergence here in the fast line of the 310 oscillator, and now Bloom Energy is having a real pullback here. So I think that it could continue to go lower for the short term, and probably most likely to test this 20-day and do some back and filling. It is possible that it fills this gap here and goes down to the previous area that was trading at around 220 to 240. That's very possible. But after this back and fill sideways range, that could go down to 220 or 240, it will set up for another move higher very easily. But this is a clear sell divergence, and we've got a red bar here, so it makes sense that Bloom Energy goes down to at least 264, possibly lower towards 240 or 239 to 240. It's a very volatile stock. The expected move in this stock is huge. It's we look at the options here, let's say that price move can play out over the course of 34 days. The expected move is $75 in Bloom Energy. So let's say this correction, this back and forth correction of Bloom Energy plays out over the next 34 days. It could easily go down 75 points. We go back to the chart, we take a look at the chart here. We look at the price, it's at 275. We look at the options, we have an expected move of 75 over $76. Well, with the stock at 275 here, it can easily go down to 200. That's what the options are saying. So we could easily fill this gap at 240 and actually go down to here near $200 a share over the course of the next month, and then turn and go higher. So that is my outlook for Bloom Energy, and that is all I have to say about that. So that is my market commentary for the week. I will talk to you guys all later. And in my future broadcast, I'm going to try to make an effort to go through more individual stocks and talk less about my opinions on AI and macroeconomics. I think people enjoy looking at individual stocks, and I don't think there's enough people that do that, specifically for individual stock picking. But I also think having a foundation is important, and I think you need to make sure that you don't get bogged down by these naysayer perma bears that just don't know what they're talking about. They really don't. I'm not saying, and that's what I was saying today. I'm not saying that you can't be, open-minded and understand, the bearish case. But the problem I have is that there's so many perma bears that just don't know what's happening underneath the surface. Like, give me a tangible bearish case. And the fact that the best bearish case comes from people that are bullish, kind of, it's kind of comical in a way. The best bearish cases are inflation takes hold and keeps going higher, and the Fed has to hike rates, and that over time companies are unable to monetize their tokens because they're not getting, for whatever reason, they're not able to monetize their tokens enough when they use AI, and they have to cut back their CapEx. With all that said, I will talk to you guys all later. Take care. Bye-bye.